Today's topic, exploring controversial and aggressive tax strategies. As we get near the end of the year, we start to hit what I like to call tax crazy idea time, when clients will come to us because they saw something on social media that they thought sounded good, and then we have to slowly walk them off that ledge. Now, let's start with the first disclosure. Guess who's not a CPA? This guy. So anything we discuss today, you should always discuss with your accountant. Some of these that we'll discuss are extremely legitimate. You could really argue all of them are legitimate. Some are just abused more than others. Some are maybe a little bit more aggressive where you get some extra eyes on you from the IRS. But that's the fun of this video. We're going to walk through three big ones that I see quite a bit. Almost every single year, we'll answer questions to these three a lot. One of those actually essentially fell off after 2022, which will add context to that. And then I'm going to add in two bonus ones. So essentially, as I was laying out the plot for this video, I got two more ideas that I thought, you know what, we see these quite a bit as well. Before we get into the details, if you haven't subscribed, now's a great time to subscribe. Also, we are starting to get a lot more questions. Drop us some questions, some comments. Let us know what you love, what you don't like, what we can do better. And if you click on the little bell icon, you also get a notification every time we release a new video. Without further ado, let's get into the first topic. All right, first up, employing your spouse or children. This one is probably the least controversial of all of them because you can do this one properly relatively easily. But in the definition, we use aggressive and controversial. I think that's more or less how it's done. So again, CFP Chad, not a CPA, confirm this with your accountant. Make sure you are doing it the right way. The big thing we see here quite a bit, I'm actually going to transition to the kid side of it, is we'll see that individuals are utilizing their children to maybe do small things around the office. All legitimate stuff. The problem then becomes they pay them way too much, right? Little Susie shredded papers 1 day per month. Salary, 30 grand, right? I'm being a little bit over dramatic, but that is where we get concerned that it's not a reasonable pay for what they were doing. One that we used to use all the time, right? We're going to use our kids in social media. We're going to use our kids in some print. Well, historically, before, those things in our pockets were essentially stronger than any professional camera that you could buy, you had to go and get professional pictures of those kiddos. That was actually a common reason to utilize a deduction for our children. Now, obviously, if you're utilizing the print and all that, but if you're paying your kid to be a model, what is that going rate, right? Again, you do one or two pictures, you do a social media post here or there, probably can't be paying them 30 grand, right? So the big thing with this topic, and same thing with spouse, right? You have a spouse that is doing some work, but you wanted to give them a much higher salary because that's the way that you wanted to try to move some income. To me, I think the easier way to move income has always been the kids conversation. Under age 18, you don't have to withhold for Social Security or Medicare, so there's kind of already a big tax benefit in there. Getting some money to the children so that they can do their own Roth IRA. Don't you wish someone would have told you to start doing a Roth IRA very young in life? The other big one in there is age. I believe the IRS limit is still the age of 7. So under the age of 7, it doesn't mean you can't hire a child, but expect to possibly get a letter from the IRS saying, hey, explain this in more detail, because it's hard to give 7-year-olds paid labor, right? Again, little things here and there. So while the idea of employing your spouse and children is definitely a very common tax strategy, my main point to you would be just make sure everything with the IRS and taxes, document it, reasonable pay, make sure you're doing it the right way, right? There's always a little bit of a gray area in terms of tax planning, but you don't want to be overly aggressive with this. The big issue there is going to be when you're paying a lot more than likely what the required work was from your spouse or your children. So number one on the list, very common tax strategy. The key is you want to make sure it is a legitimate tax strategy and you're not abusing it, but employing your spouse or children. Number two on the list, the S-Corp and a low salary. Again, all legitimate, likely one of the biggest tax savings out there, although I will argue that I do believe S-Corps are also abused sometimes in terms of accountants maybe trying to make things a little bit overly complicated. Don't drop me any hate mail. Just saying that we have seen times where clients have come to us with an S-Corp, but nothing was set up appropriately, right? It added this extra return in there. It made things more complicated, but the actual benefits of it weren't being seen, whether that was just not enough income or actually not taking a salary properly compared to draws. But the main issue here is taking too low of income. And for our people, physicians in particular, but we also know a lot of high income professionals also tune into the channel. It's easier in your world. You can't be, a brain surgeon and trying to say that my reasonable salary is $50,000. You don't even need to be an IRS agent to know that that doesn't seem legitimate. So you need to be very careful here on finding that reasonable pay. You should definitely be working with your accountant. Sometimes accountants can be overly aggressive, right? But the key is you want your accountant or your own research to give you a good idea of where you need need to be for a reasonable salary. And to add context, this is not a topic you're familiar with. The big benefit to an S-Corp is that you take a reasonable salary and then you take the rest in draws. And the main win there is that you're avoiding the FICA taxes on the draw portions. So you're trying to take the lowest but reasonable salary, and then the rest you would take in draws to avoid that FICA tax. Now you're probably thinking, oh, I'll just Google this on IRS.com and it'll type in, financial planner, fair salary. Unfortunately, we don't have that context. If we had that context, it'd be a lot easier. But the IRS does not publish that to say, hey, based on this specialty, this profession, we think that you should be this. And that is where the issue lies on not taking it too low. This is one that you should be working with an accountant. You should be working with an accountant that is very well versed in this topic. And then that is where you build this the right way. But number 2 on the list, one that is questioned quite a bit. I think most people come to their senses after having conversations, whether that's with their accountant, their financial advisor, going through their own research, right? And coming to that correct answer, even though there is not a correct answer. But we see this one missed quite a bit, but also very common question. So just be very careful, do your research. Probably note this on every single one that we covered today. Document. If you think, 100,000 or 150,000 is your reasonable salary, make sure that you have some data to back that up. Heaven forbid you are audited. You can say, well, hey, this is where I believe based on these hats that I was wearing that this is where my reasonable salary should be. But number 2 on the list, do not take too low of a salary in that S-Corp. All right, number 3 on this one. I chuckle because the amount of times I've had cold sweat beat down my neck from this topic is endless. Land conservation easements. Now, in full disclosure, pre-2022, very popular topic. Now, out of the clients that we work with, not many of them did this. A few of them did. Usually it was a recommendation from their accountant. But with these land conservation easements, the main thing was really this multiple per se, trying to keep it, as simple as possible, where you could invest into this land conservation easement and they'll say, hey, if you invest $1, we are currently at a 7 multiple. So you put in $1, you get a tax deduction for $7. You're probably sitting here watching this video like, sign me up, let's do it. Well, and they've been around for a while. I believe it was 1970s is when land conservation easements come out. And multiples essentially could range anywhere from 1 to 20. And this is where it gets extremely aggressive, is when you get into those higher numbers. And to give you context to it, in 2022, IRS comes out and says, no, new number is only 2.5. So now you can never go above 2.5 multiples. So if you put in $1, you get $2.5 back in a tax deduction. So today you actually will pretty much see nobody utilizing these. Accountants aren't recommending them anymore. Now there's other items that are kind of getting built up in the pipeline that are almost kind of filling this rate in a different way. But the actual land conservation easements are not nearly as popular now at that 2.5 multiple. And to that context, even the accountants that we have worked with our clients that are utilizing land conservation easements, even their accountants and us included have come out and said, hey, don't forget, this has been on the IRS's watch list for many years. A lot of these will be audited at some point. Now, the fund can be, the conservation easement can be audited. Doesn't mean that it's going to have a direct effect on you. And, at some point, you may have to pay this back if they were too aggressive on their multiplier. So not as popular, but if you're watching this video and you are a person that enjoys a good tax strategy, which is probably how you stumbled across or upon this video, land conservation easements pre-2022, extremely popular. They will not be as popular going forward as long as that 2.5% multiple is built in there. But our number 3 on the list today is the land conservation easements. All right, for the 2 bonus topics, first one up, the Section 179 business vehicle deduction. A popular one. Everybody loves this one. If you're thinking, what is this one? This is the 6,000 pound rule. This is where if you buy a vehicle over 6,000 pounds, you can take the full deduction in that given year. So very popular strategy. Wait till later in the year. You buy that big old heavy SUV. You drive it 1 mile for work. You say, it was 100% vehicle deduction that year because I drove it for 1 mile and it was only for work. Doesn't work. Got to be careful. It needs to be over 50% for business use. And the reason why I use this rule, because we work with a lot of fantastic individuals, and this is a very common question, right? We all need new vehicles, and we're trying to think what's the best way we can do it. We also like tax deductions. This is like your 1-2 punch. A lot of our clients, they're in larger families, so we got to buy the huge SUVs. What are huge SUVs? They weigh a ton, right? They weigh over 6,000 pounds. A lot of them weigh over 6,000 pounds, especially the big old ones. So my main update here for you is, yes, over 6,000 pounds is a very good one. Buying it later in the year, sure, trying to time it a little bit. That's not a workaround though. The key is it needs to be over 50%. So do not try to sneak this one by the IRS where you just went and bought a heavy car. You said it's for the business, but it's really a personal vehicle. You need to make sure that it's over 50% for business. Again, popular topic because again, we always need vehicles. It's just humans in today's world. Tax deductions, you get this nice 1-2 punch here where you can really get all that depreciation then in a given year. But be careful, over 50% is the key here, and over 6,000 pounds, but that's usually the easier one. All right, last up on our list of fun and somewhat crazy controversial tax ideas is one of my favorites. As a golfing fan myself, we call it the Augusta Rule. Why is it called the Augusta Rule? Well, it comes back to the Masters in Augusta, Georgia. This is where that rule really got fired up. So what it says is this. It says you can rent your home for up to 14 days to your business and get that income tax-free. Now, it's not a tax deduction, but you would get it tax-free. Where do we see issues here? Well, you can imagine, the good news is the IRS has also issued rulings on this one. That helps a lot. Anytime you get a controversial topic, you kind of want the IRS to catch one of the bad people so that they will give us more context. And this one has had a lot of context provided to it. But the number one issue here is that you overinflate the price of your home. You can't be like, you know what? Beautiful house, great city, 100 grand for the week. This is where it's abused. So what the IRS would like to see is that you did some research. What's the house next door? Very similar to you, very similar comp. What's that rent out on Airbnb, right? How about the hotel down the street, right? If the hotel down the street is not 100 grand and gives you all the rooms that you need, your own conference room, 100 grand might be overdone. And 100 grand is also very overdramatic. I guess it depends on your house, but that was just me being a little bit overdone. But regardless, you got to find a good rate. We've even seen others get extremely nerdy with this, right? So you're utilizing your home for business meetings, and let's just say there's 4 bedrooms, and one of those bedrooms is not utilized, and one of the main spaces is not utilized. We've seen some accountants actually do the square footage of the house and then the actual rooms of the house that are being utilized for the meeting, and then take that percentage of the fair rate. So like, boom, that's organized, that's detailed. We've seen others still kind of take the whole house because you sit there and you're like, well, you know, if we needed 3 bedrooms, it's not like we're going to rent out the 4th bedroom during that one. So like we still need the whole house, even though that room wasn't done. Again, not a CPA. I am a CFP. Confirm that with your CPA. I think if you're very, very cautious with it, I kind of like that. It just depends on how conservative you want to be with your tax planning, where the accountant might come in and say exactly what we noted before that in terms of like, yeah, sure, maybe utilizing that room, but you still utilize the entire house. So main thing here is fair, reasonable rates compared to other options. Main things being local Airbnbs, VRBOs, then also comparing some hotels, and then using a good average rate. Document. What's been the key through all 5 of these now? Document. Save the screenshot from Airbnb. Save the printout from the hotels.com, whatever you're utilizing, and save those. So that if you are ever audited, you can sit there and say, yeah, we charged $1,000 per day, but look, we needed 4 bedrooms, we needed a conference room, we were doing all of our meals in the house, you know, to have a hotel or a similar house, you know, this was a fair rate. So document. But I do love that rule. I think it's a really neat rule. I actually shared this rule with one of our clients in another conversation, and a lot of these same details. So that's why it's one of those ones that actually got added on there. But those are the 5 that are somewhat aggressive if you're being aggressive, somewhat controversial if you're being too aggressive, but all legitimate tax strategies. But you need to be careful. You need to work with a very good accountant. You got to make sure that you understand all the rules, because the last thing you want is for this to go bad. You know, they usually catch it a few years later, then it's really piling up on you. So just be careful, work with a good accountant. You should be in a good spot. All right. And there you have it. Exploring aggressive and controversial tax deductions. Started with 3, gave you 2 bonus as I built on my notes here, just thinking through this topic. And, you know, main takeaways again, document, work with a good accountant. While these are 5 legitimate tax deductions, we do see them abused quite a bit, and you need to be careful there because you do not want this to go the wrong way on you. But very popular topics. And again, you know, as we kind of get towards the end of the year, these will start to pop up more and more as we start to get into that year end. You say, I don't like that bill to the IRS. How do I get that lower? And while some of these will give you an option to get it lower, you need to make sure you're doing it the right way. So as always, thanks for tuning in, hanging out with me for the last 15 minutes or so. Again, if you have not subscribed, please do so. Also, please feel free to share any comments, ideas, thoughts, questions, comments, concerns, anything in the show notes below. But as always, thanks again for hanging out with me, and I will catch you on the next video.